15.5%. That's the gain in the S&P 500 right now. That's where it'll settle out. That's without dividends. Of course, you can add 1.5% or something for dividends. But what's striking about that is if you go back 4 years, 4+ years since the 2016 election, it's been about 15% annualized gain in the S&P 500. Since the low for the last deep, long bear market, global financial crisis, March 9th, 2009, the annualized gain in the S&P is about 15.5%. So this weird regular return pattern, but the path has been so unexpected, dramatic, violent, especially this year. And I think the key thing to think about from a year ago is we went from late cycle conditions to early cycle conditions in a blink. 1 year ago, the expectation for 2020 by the Fed, by everybody, 2% growth, 3.5% unemployment. We'd be talking about raising interest rates by the Fed right now into next year from 1.5% to 1.75% to something like 2%. So that was the idea. The profit margins were peaking. We were going to have to worry about wage growth pinching profit margins. And in fact, we just had the yield curve invert the prior year. So in other words, everyone was in this vigil for when's it going to end. And then guess what? It ended in this flash recession and a massive policy response that has essentially accelerated the recovery dynamics off a typical recession. And the market says, great, this is all we want. We want the Fed not budging from zero forever. And I don't care about, stock valuations being high because credit conditions are generous and we can live with all that. The big question to me is where we can start from valuations at this level without probably the benefit of getting them expand much next year when you have most of the S&P 500 is not really geared to an economic acceleration. What does that mean for the index? Does it just mean, Morgan, you have to pick your spots from here?
Yeah, that's right. We're looking to see the earnings catch up with the price. And from there, what does that mean for the price? I mean, it's something we've been talking about in general recently. I mean, the Dow and S&P are up for the 7th quarter in the last 8. So just that first quarter when we saw that, or I guess it was the second quarter, when we saw that huge market plunge into bear territory, that's the only time that we've actually seen down quarters for those two major averages, which is pretty incredible. It just speaks to how quickly the market fell and how quickly it bounced back. Going back to your point, Dow's up 6.5% year to date in what's left of this year. The S&P, as you mentioned, up 15.5%. The Nasdaq up more than 43%. This is one of the stats that really gets my attention here, that the Nasdaq is seeing its biggest outperformance to the S&P 500 since the dot-com bubble of 1999. I mean, we have had a number of folks come on here and say certain aspects of the market, certain, I guess, metrics, if you will, feel a little bit like the late 90s, early 2000s, and that tech bubble. It's certainly something we've been talking about, Mike. But the other thing I would just point out, unrelated to stocks, if you actually look all around the globe at all the best performing and worst performing assets and asset classes of the year, one of the top performers has actually been silver. It's up 48%. Year to date. And even then, it's still, by some metrics, for example, the gold to silver ratio, still pretty undervalued versus the run we've seen in gold. And this is very much a story about same reasons as gold, right? Hedge against inflation, weak dollar, et cetera. But it's also a story about electrification and what we're seeing in industrials and what we're seeing in tech. Similar story for palladium as well, which jumped, I think, 22% this year. But that's after a huge run last year. I mean, the price of palladium, I believe it's trading well above the price of gold right now. And that also, I think, goes back to this conversation about where we're seeing exuberance in the market around things like EVs and some of these new emerging technologies for which there still aren't necessarily sizable revenue streams. But the offerings that are going out to the market are certainly getting a lot of investors excited, Mike. Yeah, people are, without a doubt, extrapolating these very long-term trends very far in the future and willing to pay up for them right now. So we've gone from will the economy recover? How is it going to recover as the animating force in the markets, which I think was going on in the summer and into the fall. And now it's just feeding on itself. The risk appetites are where they are. The IPO window wide open. The SPAC story. All of it is now about just this sense that the Fed has taken away the extreme downside scenario. The companies that have good cash flow have been priced pretty tight to those bond yields. So in other words, it doesn't seem like you can squeeze those for that much more juice. So now it's, okay, give me a big picture story I can believe in. And it's the capital markets, David, are willing to accommodate a lot of those stories right now.
Shepard Smith here. Thanks for watching CNBC on YouTube.